We like the data. It's fairly comprehensive. You can do a lot of stuff with it. So we believe that this is tip of the iceberg for us right now, but we have actually more substantial plans in terms of how we're going to use this data going forward. So sentiment, right? There are many measures of sentiment. So now we're talking about new sentiment. And the sentiment in this case, right, is attitude and opinion expressed in media. And if we talk about Ravenpack, that media is going to be Dow Jones Newswire, Wall Street Journal, MarketWatch, Barron's, social tweets as well. So it's a fairly sophisticated corpus of data, unstructured text. So Ravenpack, what they do is they take this unstructured data, they process it and come up with quantitative scores. Quantitative scores are between 0 and 100, 50 is neutral. And Peter gave a pretty good idea of what the data is. So I will not talk too much in the details of what the data is. There are several sentiment scores. There's more than one, and you can probably play around with some of those scores. In this presentation, I'm going to focus only on two, and I will explain why I picked those two. The key question that I would like to answer today, and some of them you already know the answer, but still I would like to answer. One is, does the data offer something new when you control for other well-known risk and alpha factors? So most of the research that you see on sentiment scores, on some other factors, is on if you look at the factors standalone. And Peter gave you 3 use cases, right, of how you can use new sentiment signal. Most of that research was done as standalone signal, which is perfectly fine. But what I would like to share with you today is how does this factor look like if you have some other factors, value factors, sentiment factors, quality factors, momentum factors. How does it look like, I think more importantly, if you control for some other sentiment measures? In particular, we're going to have, you will see that we have IBIS-based sentiment, and we use short interest as another measure of sentiment for us. So, you know, the first inclination, right, someone comes and says, okay, here's new data set, right? Let's build a sentiment signal. And for better or worse, just to give credit is due, IBIS has been around for a long time, and then you say, you know, why would I use it? I will probably just use IBIS data, and I will be good enough. So what I'm about to show you is that IBIS data is good data, but Ravenpack has additional information that is not captured by IBIS data, or short interest data for that matter. The investment horizon of the data, and again, I think that the idea, at least from previous presentation, is out there, consensus is that it's relatively fast signal. I still need to raise this question, and the reason is just to give a little bit of marketing for what we do. We build risk models, and with our recent generation of risk models, we build risk models for different horizons. We build risk model for long-term horizons, let's say 1 year. We build risk models for medium-term investors, let's say 1 quarter, 6 months, and we build trading model, which is for short-term investors, daily horizon, maybe up to a week horizon. So if we are to use new sentiment data, then in which model do we include? And the suspicion is that probably it's not going to be used for long-term model, which has 1 year horizon. But still, this is a question, the relevant question, and the answer is obviously we'll use it for trading model, we'll use it for medium-term model as well. But I will show you why we're doing that. So what is my message points today? So if you need to go, walk away, and so on, there are 4 relatively simple messages I would like to give you. One of them is that we use new sentiment in our risk models. So right now, in our latest generation of risk models at Barra for US, and we're working on with the same for globally, and Asia model and so on, we're using new sentiment data fairly extensively. For US in particular, it's in a trading model and medium-term model. So the signal is there, right? So maybe I should just stop and walk away. But there are a couple of other messages that I would like also to convey. And one is that new sentiment data are orthogonal to other well-known risk and quote-unquote alpha signals. So that's one, because again, most of the research is done using standalone or maybe 2 or 3 proxies for like size, value, momentum, and that's basically it. I think that the value added of today's presentation is that we have 24 factors in total. And if you look at those 24 factors, you will realize that it's a fairly good set of quality value factors. So we do have a good factor set to control for any effects or anomalies that you can think of. And if this signal survives, even in this setup, the signal has some value added in it. So that's one. It does have value added in it. Number two is we test level and dispersion of news sentiment. And usually when people talk about sentiment, they talk about level, right? You're going long companies that has high sentiment, let's say higher sentiment, and you're underweight companies that has low sentiment. And that's usually how we think about it. Then everything else is technical details, how you decide, what is high, what is low. And what signals that we build are based on that principle. We have a couple of signals that look at highly ranked sentiment companies, low ranked sentiment companies, and we go long those that are highly ranked, and we underweight those that are low ranked. The interesting part, at least it was interesting for me, that even if you look at dispersion of sentiment scores, that is also effective in predicting returns. If you think about it, using dispersion has a lot of sense. Why does dispersion should predict returns? And the idea is as follows. Some investors, if there's dispersion in sentiment scores, it means that there are scores that are very high positive sentiment, there are scores that have low negative sentiment, and it may maybe go back and forth over some period of time. What does it mean? It means that there is some disagreement in media and more likely in investment community as well in terms of the prospect of the company. If there is disagreement among investors, what does it mean? Investors who have high positive view of the company, they can establish their long position. It's much easier to go long company than go short. So if there is high dispersion, those who believe have good opinion, have good news sentiment about companies, they will go long the company. Those that have negative sentiment, unless you are a sophisticated investor like hedge fund that you go and establish a short, most you can do is not to buy the stock or underweight the stock, hold nothing, right? You cannot really short that easily. So in this respect, we believe that companies that have high dispersion of sentiment will have negative relationship to their future returns. They will be overvalued or overpriced. And that's what we will see. And investment horizon for using the data is relatively short. And this is, again, something that I think is out there. People know about it. What we will show is that, again, this multivariate framework, these results still hold. Decay rate of information ratio for the signal is pretty fast. So data, we're looking at US. So for now, it's US region. Again, we have risk models in other regions, for example, Asia. We're working right now on incorporating this data in our global model, in our UK model, but this presentation is about US. The period is from 2000 to 2014, and we focus on two sentiment metrics. It's what is called CSS, Composite Sentiment Score, and ESS, Event Sentiment Score. I mentioned that there are more sentiment scores, and I lost track of how many sentiment scores. I used to know it, so I will not give the number because people who in the room know better than I do. But composite sentiment score is a composite of 5 sentiment scores. In general, we don't like to have a data mining. Okay, we don't like to look at sentiment scores separately. So if there is composite sentiment scores, our inclination is to go with a composite sentiment score. Out of sample, we believe that composites, kind of averages, will perform better than in sample. So in this respect, CSS was our score of choice for 5 other sentiment scores. Just to give you a sense of what those 5 sentiment scores are, they basically look at various events. So they may look at not only events, several various source of articles. So one of them may be looking at commentaries and editorials. One of them may be looking at reports. One of them may be looking at earnings revisions or earnings announcement and so on. So it's really sentiment scores. are based on where the data is coming from and what kind of data is coming from. Event sentiment score, we use it together with CSS, together with company sentiment scores. Why do we treat event sentiment score separately? Event sentiment score is based on type of news or type of articles that are identified by financial analysts or financial professionals as having an impact on stock price. So in this respect, the set of news, the set of tag that you're looking at for ESS is a little bit more narrowed down, and if you will, a little bit more maybe sophisticated from investment community point of view. So we saw that looking at ESS separately may bring something extra to our model. In general, these signals are fairly highly correlated. CSS and ESS, you're probably looking at 0.45 correlation on average, so it's from 0.4, 0.5. So it's not like you're looking at two different dimensions of sentiment. They are, in sentiment scores, it's hard to find sentiment scores that are not highly correlated. You either have good news, good view, or bad news, bad view. So in this case, CSS and ESS, both, they're fairly highly correlated. We analyze, as I mentioned, dynamics of sentiment scores, i.e. the level of data. We expect positive relationship. Companies that have positive score will have positive excess returns in excess of market, and companies that have negative scores, they will underperform. And dispersion of sentiment scores, we're looking at standard deviation of sentiment scores, and we expect negative relationship. As I mentioned, we believe that this negative relationship is due to some market frictions. People who have positive view about company can establish their views, they can go along the company. People who have negative view, or investors who have negative view, may be restricted from doing that. Okay. Should I take the fall for this one? In my presentation, it wasn't like this, but anyway, so what does it mean? That's right, that's right. So ESS, CSS-based signals, right? So these are level of signals. So that 1.5 minus 1 negative 0.5, those are indicator functions. So what we're looking at, and first you're looking at calculate daily news sentiment score. So we're computing daily news sentiment scores. Okay, how do we compute them? Very simple, and that's actually what I like about the signals as well. You know, we are going in some case maybe the path of least resistance. So we want sentiment scores. So what do? We look at positive news, negative news, and find the difference. If the company had 100 news arrivals during the day, 60 of them were positive, 40 of them were negative, and positive means more than 50, negative means less than 50, it means that it had positive sentiment during the day. Once we get daily sentiment, news sentiment, then we compute, okay, thank you. Then we compute average sentiment score and deviation. And average is, in this case, we're looking at average across days. And after that, we construct a signal. So signal is over here at step number 3. This is some standardized measure of sentiment. You can see that we basically look at mean or sentiment over the last 2 months, 42 days, compared with the last 6 months, and then standardized deviation of last 6 months. Why do we do that? I think standardization makes a lot of sense, right? You know that companies that are larger cap companies will have more news volume. So we don't want sentiment signal just picking up size effect. So by standardization, that's our way of removing size effect. We also find the mean over the last 6 months. Why? And I haven't noticed it in Ravenpack, to be honest, but then there's a lot of data, especially in academic newspapers, in academic papers, that talk about some negative bias in news. All right, I like Jeremy's talk, and he had some negative effect of, I think, number of news coming. And I was wondering if that number of news coming has negative effect just because the news that is coming is negative. So people sometimes talk about negative bias in news coverage, right? And the idea is that if you are covering small cap name, people don't really pay that much attention to positive news. And it's my argument. It's just the argument goes in academia. Whether you believe it or not, I will tell the argument. So for people to get attracted to the news or to the articles, to get attention, you need to have something negative. So as a result, more news that is out there is negative news. So in this respect, what we want is we want some kind of benchmark measure of what the news coverage is about the company. That's why we have this mean over 6 months. And mean over 42 days is deviation from that baseline level of news or sentiment for the company. So this is the level. The second one is just the dispersion, and it's pretty easy. It's standard deviation of all news arrivals over the last, in this case, over the last 1 month. Very simple, right? Okay. So the way we constructed the signals, we're looking at 2 months, 6 months. And in general, for this kind of analysis, I think that those signals are kind of slow. For news sentiment, you probably can build much faster versions of the signal. And if you're after performance alpha properties, then faster versions will perform fine. So if you will perform better. So if you want to see signal performing well, if you are a trader with high turnover and so on, you can obviously improve on this. So what we constructed for you is relatively conservative estimate of what this data can give you in excess of already very well-established signals. So half-life for exposure is around 1 month for CSS and ESS. We're using 2 months of data. And for dispersion, it's around half a month. We're using 1 month of data. So the signals are included in our trading model and our medium-term model. In general, there are several criteria how we select signals, whether they go into long-term model, medium-term, or short-term. But turnover of the signal is one of the key criteria we're looking at. For long-term models, the fastest signal that we have is price momentum, half-life of 6 months. So everything that is faster than 6 months goes into trading model and medium-term model. This is a coverage, roughly. It's MSCI IMI, roughly. You can see it between 2,500 names. So I have roughly like maybe 8 minutes left. So what I wanted to discuss is, in general, we have like 3 stages of testing new signals into risk models. The first stage is multivariate analysis, multivariate regressions. And that's what I'm going to talk about today. Then we'll look at number of various portfolios, random active portfolios, long portfolios, style till portfolios, and so on. And then we look at optimized portfolios, in which case we look at backtest portfolios, we look at mean vol portfolios, and what we call characteristics portfolios, which are also use optimizer in their construction. For this one, it's looking at multivariate regression in the presence of these 24 factors plus industry factors. So if you think about it, we're looking at the ability of news sentiment data provided by Ravenpack to predict stock returns in the presence of these 24 plus industry factors. There are 60 of those. So it's a fairly stringent test for a signal to overcome. In general, if we have a signal, that's the way we do it. We don't want to have one more take on value or one more take on quality if we already have several value signals, earnings yield, value, dividend yield, and so on. We don't want that. We don't want signal that is already spanned by what we have. In red, sentiment, short interest. Sentiment is IBIS-based sentiment. And it consists of several factors. Revisions ratio, changes in analyst forecast. So that's in sentiment. We have short interest, which we also think about as kind of sentiment indicator of very sophisticated investors. Another one, and there was also like talks about like reversal and so on. We can see that we have short-term reversal and bounce factors. So if news sentiment is just capturing some kind of liquidity effects and noise and so on, then we would believe that that would control for that. So as you can see, we have a fairly comprehensive list of factors in the regression. And what we do is each day we take stock returns, regress on these factors, plus industries, plus news sentiment signal. And we look at T-stats, we look at performance, i.e. if there is any drift in the signal, and we look at something that we called, not we call, in econometrics called variance inflation factor. What is variance inflation factor? Variance inflation factor is computed as 1 divided by 1 minus r squared from regression of news sentiment signal on these styles plus industries. If the signal is spanned by these styles and industries, we expect very high r squared. So you can see if r squared is, let's say, 0.9, this variance inflation factor is going to be 10. If r squared is about 10%, then this variance inflation factor will be around 1. In general, people would, in a econometrics book, would say that if variance inflation factor is more than 5, maybe you should think of doing something about the signal, or you should think whether you want it in your model. If variance inflation factor is more than 10, then you shouldn't have it in the model. That's how the story goes. So, dispersion. Dispersion at the top shows performance, right? Performance is important for us because we want to have in our model something that can predict returns. If you can predict returns, then the chances are that some investors will start betting on the signal. It may get crowded, so we want to capture some of that risk. IR is negative 2.5. Again, we expect negative slope. It's negative, so that's good. IR is very high, surprisingly high, you may say, and I will agree with you, but it is high. T-stats are relatively low. So for our risk models, we're looking for T-stats maybe around 1.6, 1.8, closer to 2. So in this respect, T-stats are somewhat on the lower side. Variance inflation factor, which measures whether our factor is spanned by other factors or is orthogonal with those other factors, is actually very low. So this is something that we want to see in our signals. If our signal is to be added into the model, we want to see low variance inflation factor because then it means that we're adding new data into the model. So variance inflation factor is low. T-stats are not very high. And volatility, to be honest, 1% is not very high either. The next one is ESS. ESS also is IR 1.5, volatility 0.9. The message is the same. Variance inflation factor is low, so the signal is orthogonal to value, quality, momentum measures that we have. T-stats are low, volatility is on somewhat lower side as well. CSS as well. You can see that the CSS in terms of performance may be not as consistent as ESS at dispersion, but it's still there. I mentioned that ESS and CSS, they're fairly highly correlated. The dispersion is also fairly highly correlated with those two as well. So this is volatility. Even though they are highly correlated, you can see that the dynamics volatility is a little bit different. For example, in 2011, during the US debt ceiling crisis, you can see a spike in ESS and dispersion signal, but you don't really see it in CSS-based signal. So they're correlated, but there is some difference in dynamics of the signals, which I think is also interesting to keep in mind when you build the signal. IR decay is fast. It decays fast. Let's say over the like week or 2 weeks, it's gone. So to summarize, cross-sectional T-stats are lower side for the signal. Variance inflation factor is very low, so it's orthogonal data. Predicting stock returns, they're very effective in predicting stock returns, even when we control for IBIS-based sentiment, short interest, and some other value quality type factors. So we want to introduce this signal in our models. However, low cross-sectional T-stats and low wall give you a pause. It's not unique to Ravenpack, to be fair. We also use implied volatility data from option metrics, and results will be somewhat similar. So what we do then is we build what I call the monster sentiment signal. We build a sentiment that has IBIS data, sentiment signal that has new sentiment from Ravenpack, and it has also implied volatility skew data from option metrics. So that's the data that goes into our risk model. And that is the signal that goes into our short-term trading model and goes into medium-term model as well. This is how the signal looks like. You can see that for this signal, volatility is higher now. T-stats are also higher. And IR is pretty high as well, 1.7. If you look at decay rate for the sentiment signal, again, you can still see this decay over the first week. It's coming from new sentiment, and skew is also somewhat on the faster side. But then you can see that it kind of flattens out, and for 2 months, it's around 0.8 range, which is actually a very good range, I believe, for sentiment-based signals. And here's volatility, and you can see that it's picking up also dead ceiling crisis, which we saw in new sentiment as well. So, summary of data. We have tested Ravenpack data. We have tested it, I think, in the most stringent test you can come up with in the industry, right? We have 24 factors. Those 24 factors have a number of quality measures: profitability, earnings quality, management quality. They have a number of valuation measures. They have IBIS-based sentiment. They have short interest. They have factors, short-term momentum factors, which capture some of these liquidity effects. And what we find is that the signal survives. It has predictive ability for returns. So there is information content in the data not captured by those other signals, which we like about the signal. We wanted to provide to investors or to be able to use it in our risk models. Both the level and dispersion of new sentiment are effective in predicting returns. And again, I think that it's probably level is something out there. Dispersion I haven't seen much, so I think it's kind of interesting to see as well. New sentiment data are orthogonal to alternative proxies for sentiment. I think that's also something that is fairly interesting to take away. That's pretty much it.
That's fantastic, Stan. So we've got time for just a couple questions. So let's start right here.
Are you suggesting that news is really a factor or a risk factor? And if so, because news is really non-continuous and it's idiosyncratic in nature, is it fair to say that it really is a risk factor?
So I will not get into debate risk versus alpha right now, but I will answer your question. It definitely has alpha characteristic. It predicts stock returns. Volatility is on our lower side, so it's probably the argument more into the latter, like alpha side. So I believe that the distinction between alpha and risk factors is, in some sense, is artificial. So, and I'm not sure it's productive. But to answer your question, it is part of our sentiment signal. We believe it's good risk factor. It does have predict high volatility and predict returns and risk quite well, especially during the crisis periods.
Okay, one more question. I actually have one, Stan. I'm very curious to get your opinion on, do you find that there are certain factors that work better during certain times, specifically some of these more modern factors that you started incorporating into your model?
Some of the factors, even, I see, maybe it's already turned off. So there are some factors that behave differently in certain periods of time. So for example, some of this momentum-based or news sentiment-based, when there is a lot of dispersion, a lot of market volatility, I think some of those signals perform better. So if we go at, like CSS is probably one of the examples that you can see, factor perform well in the beginning, then it kind of flattens out, but then you can visually see the uptick. So this is a crisis period. So there are some signals that perform well when market volatility is high. momentum-based signals, I think news sentiment-based signals that have shorter window in construction perform relatively well. Some signals have the opposite property. Momentum performs poorly when volatility spikes, so it has negative correlation with market volatility. In general, and this is part of research that we're doing at MSCI, we're looking at how signals work depending on different market environment. And we find that signals do have different payoffs when economy is in a recession or expansion. Maybe intuitively, if you think about quality type signals, profitability, earnings quality, it has negative correlation with market. So when you talk about flight to quality, when market is kind of crashing, when there's negative economic news, quality type signals perform well, value type signals usually don't perform that well. So there is dependence of factor performance on some of the economic events that we find, and it's actually something that we're looking at. We don't take into account, we don't take it against the factor if it performs well when market is up or it performs well when market is down. You know, in the end of the day, we're after risk. Whether it's risk as an upside market or downside, we will take it.
Excellent. Thank you, Stan, Radchenko, everybody.